On a Monday evening, Disney finished a high-stakes meeting regarding their billion-dollar partnership with OpenAI. 30 minutes after that meeting ended, the call came. OpenAI was discontinuing Sora. The app, the API, and the entire project were being scrubbed. One person familiar with the deal described it as a total rug pull. Disney responded by pulling their investment entirely. OpenAI currently holds a massive $122 billion valuation. Earlier this year, Sam Altman was pitching Sora as a tool that would change the way humans express themselves, promising a massive expansion of creative output. This leads to a massive contradiction. Why would a company with more capital than most countries suddenly execute its most famous product and blindside its most important partners? When Sora launched as a standalone app, it hit 1 million downloads almost instantly. It dominated the App Store as users flooded social media with AI-generated clips, ranging from hyper-realistic travel footage to deep-fried memes. But that viral growth triggered the compute problem. Generating video is exponentially more expensive than generating text. Every clip requires massive amounts of processing power and electricity, creating a cost structure that scales faster than the user base. This diagram shows the disparity. Forbes estimates running Sora cost OpenAI $15 million every single day. Throughout its lifespan, Sora only generated $2.1 million in revenue. Stacked against daily losses, Disney's billion-dollar investment evaporates in just 66 days. Beyond the math, the legal risks were mounting. Sora was a content moderation nightmare, capable of generating copyright-infringing material and deepfakes at an industrial scale. The liability for OpenAI was becoming impossible to insure. These losses are part of a wider trend. OpenAI is currently on track to lose $14 billion in 2026, even with revenue hitting the $20 billion mark. The decision to kill Sora was a financial amputation. It was a necessary move to stop the bleeding for a company that is burning through cash at an unsustainable rate. This raises a question about the company's valuation. How does a startup projected to lose $14 billion manage to raise $122 billion in a single funding round? The answer lies in circular financing. Look at how the capital moves. Stakeholders like Amazon and NVIDIA inject billions into OpenAI. That money then flows straight back to those same companies as OpenAI pays for server space and hardware purchases. Amazon put in $50 billion to justify its AWS infrastructure, and NVIDIA, led by Jensen Huang, invested $30 billion. NVIDIA needs OpenAI's demand for compute to keep selling their GPUs. This creates a closed financial loop. The massive valuation isn't based on Sora's popularity or a profitable software model. It is a mechanism keeping the hardware and infrastructure sectors afloat. Shortly after raising that $122 billion, OpenAI made its first acquisition, a daily tech podcast. They reportedly paid hundreds of millions of dollars for a show that averages only 70,000 viewers. In late 2025, that podcast formed a formal partnership with the New York Stock Exchange. As OpenAI prepares for an IPO later this year, they now control a media outlet favored by the institutional investors who will eventually price their shares. Behind the scenes, the internal structure is fraying. OpenAI CFO was reportedly removed from investor meetings after she questioned $600 billion in future spending commitments and raised alarms about failing data center buildouts. The partnership with Figure Robotics also disintegrated. Figure's CEO publicly stated that the OpenAI team was virtually worthless and accused them of trying to siphon off proprietary technology while working on site. A recent investigation by The New Yorker further detailed the internal rot, providing an 18-month exposé on the company's leadership. The report includes internal memos, where board members describe Sam Altman as a sociopath. Even his mentor, Paul Graham, told colleagues that Altman had maintained a consistent pattern of lying throughout his career. OpenAI is using aggressive marketing and media acquisitions to distract from a leadership crisis. They are cleaning the books and the public image in a desperate push for IPO cash. While OpenAI was focused on viral video clips, Anthropic was capturing the enterprise market. Claude's share of the business sector grew to 29% in 2025, winning over 8 of the Fortune 10 companies. OpenAI is now forcing a tactical retreat. Management has told staff to stop pursuing side quests and focus entirely on business productivity and AGI development. Sora was an expensive liability. To prepare for the scrutiny of Wall Street, OpenAI had to remove any product that couldn't prove its own value on a balance sheet. The industry is moving away from speculative, consumer-facing experiments. Tech giants are now prioritizing tools with a clear return on investment over the generative novelties that defined the last 2 years. OpenAI is currently sustained by the very investors who sell them their hardware. But as Amazon and NVIDIA complete their own AI infrastructures, that circular money flow will eventually dry up. When that happens, the company will have to survive on its own merits, if there are any left.